we're delighted this morning. We've got Tom Hibbard from Fuel VC, a leading VC in London, very active, to come along and talk to us this morning. And Tom has kindly agreed to field and take questions as we go through. So if there's anything you want to raise as we're going through this morning's talk, please let us know. All right, either put it in the chat, raise your hands, and we can ask Tom accordingly. Thanks, Tom. Over to you, mate.
Cheers, Ollie. Hi, all. Yeah, I'll give a quick intro to me and Fuel, but just to reiterate one of the things that Ollie said, if there's anything that I'm talking about that you guys want to ask a secondary subsequent question to, then no need to put hands up or anything, just butt in and we can dive into that, because ultimately this is for you guys to get as much out of it as possible. So if what I'm talking about is also complete ramble, then feel free to just ask a completely new direct question as well. So quick background on me. I started off in the banking world doing derivative structuring for pension funds. Completely useless for the startup world, but it was a good place to start. Taught me a lot about pension funds, and after 3 years I left with a few colleagues, one of which was a co-founder for a business called Claritex, a SaaS business, where we had an API that took data from asset managers, and then we had a dashboard and benchmarking tool that helped those pension funds make better decisions. So I had a relatively convoluted 2-year journey. We built the product, sold a stake to a reg tech company in Sweden. They then got bought out by NASDAQ, who incorporated it into one of their performance and risk products. I was not wanting to go back into a big financial institution, decided to leave at that point. And what we always laugh about in my team is calling it a non-champagne exit, hence why I'm still in a job. Then went to be VP of sales at another fintech SaaS business, really kind of deep tech product. So I came in after a couple of years and they got 30 devs on the team, built this thing. We scaled that to about 15 million ARR in a couple of years, which was really cool to be part of that journey. Had a B2C idea whilst I was there, so left to set that up. Worked on it for about 4 months with a founder who'd got a very similar idea, but ultimately at the end of that kind of 2020 summer, we were mid-pandemic, decided that we had slightly different visions. So, I mean, it's the number one killer of all startup ideas is founders disagreeing. So we decided to make the decision to cut that off early. I was talking to a bunch of VCs at the same time, and Fuel offered me the opportunity to come in and start a completely new fund at the pre-seed side, which was a really exciting proposition. So I jumped on that idea in September 2020. To give you a bit of idea about Fuel, it's all early stage software, concentrating on SaaS marketplaces and consumer platforms. It's about 70% B2B, 30% B2C. That's kind of not by design, just by what we see and what we like. We do 40 or so 150k SEIS pre-seed checks a year, which is the bit that I look after. The core strategy is doing 15 or so £1 to £3 million EIS checks for companies that are around 25k MRR or transaction revenue on a monthly basis. And that's the core strategy that Fuel started with in 2016. And then we've also got a Series A fund that we call Follow On, because it's principally for existing portfolio companies when they want to raise bridge or Series A. So that's the boring side of it. I'd say in terms of criteria, it's going to sound pretty similar to what a lot of really early stage VCs are going to say. We're looking for standout teams. Team is ultimately 60, 70% of the decision at pre-seed, given that the ideas are going to iterate and change a couple of times over, most likely before you hit on what's really going to make it work. Something always worth bearing in mind. Solving a real pain point in a large market. And pre-seed for us is just pre or post traction. So anything pre 20, 25k of monthly revs, because that's when we start classing it as seed. And also really importantly, we don't really want to do anything that's more than 3 months away from launching the product into the market and generating revenue, because that just introduces too much risk, even in what we call pre-seed. I'll say,
sorry, Bob, someone phoned me, so I missed it. What would you class as pre-seed versus seed? At what's the point at which it switches over?
Yeah, so we look at seed for us is 25 to 75K of monthly revenue, be that recurring, transaction, whatever it is. If it's a user-based model, then we obviously think about it slightly differently, but we don't tend to do a huge amount that are valued on user base. And then anything pre-seed for us is anything pre-25. We can go a bit lower than that for seed sometimes, but roughly anything below 25K monthly revs. And the other end of the scale, above anything that's 3 months to revenue. So we wouldn't go in for like idea phase, concept phase, kind of mid MVP build just because it's too early. So what we tend to do, and I'll talk about this in one of the questions later, is
okay, mother. Sorry, I was on the call. I didn't hear.
Yeah, what we tend to look for is if someone's a bit too early and we love the idea and we love the team, we kind of say, look, we can't do this now. We love what you're doing and we really like you. If you choose to go back to the drawing board and build for a few months longer and not raise, we want to have this conversation in a few months' time. If you choose to raise, then there's not much we can do from a pre-seed perspective because you're going to use up your SEIS. And you're taking a gamble that you're going to hit those seed revenues in the time frame that in the runway that you've now got from that raise, because a lot of companies end up falling in the gaps between those two funds where you've used up all the SEIS to build the product, but you haven't got to revenue yet. And I'd say that is, in this market, that's a trickier place to be. Absolutely not impossible. Like everyone's still going to look at the team, look at the products, and go, "Yeah, I love this," or "This isn't for me." But it just makes it a little bit harder.
Okay.
So hopefully that gives you a bit of an intro. Ollie, Gary and I talked about a few questions that would be useful to dive into. So I'll kind of tackle those one by one. And if there's anything within that or anything different that you guys want to jump into, then feel free to interrupt. So first one is, what's the value prop at Fuel to both founders and investors, which would be normally part of an intro that I'd give to a founder if we were on a call, but obviously saved it for this question. So I think first off is speed to decision. We realize that founders don't really want to be raising money. It's kind of the most boring and annoying part of what you have to do. So drawing out a conversation for 3 or 4 months is really not helpful to what you guys are trying to achieve. So we normally, when we see the deck, we might take a week or so to actually get back to someone because we've just got so many things on the plate at all times when you're trying to do the volume that we're doing. But at that point, we have that first meeting with the founder, which will be with the deal lead you're most likely going to work with the whole way through your time at Fuel. We normally say it's about 10 to 14 days from that point to a decision. And obviously this is pre-seed, so there generally is less data, less metrics, less kind of stuff to churn through. So it's more about that hypothetical conversation of like, what have you built and where are you going in the next 18 months? So that allows us to move fast, but we know that's not the case with everyone. So that's a key one. I think the most important thing is everyone at Fuel in the investment team comes from an operator or entrepreneur background. So you heard a bit about what I've done in the last 10 years, but the stories are very similar across the team, just different levels of experience and success. So Mark, our GP, built a company called My Voucher Codes, which was really, really successful, which is what's allowed him to kind of go from an angel investor to building the Fuel proposition out, and sits atop and leads those 3 funds that I was talking about. But we've got expertise in consumer, business, marketplaces, e-com, mostly in the go-to-market space. That's what I think Fuel's really, really good at, is kind of growth knowledge, marketing knowledge, sales knowledge, enterprise sales knowledge. But it's really important that we have that because lots of people going to VC come from consultant and investment banking backgrounds. That's great as you get towards Series A and growth, because you need people who are going to help you with strategy at that Series A level from a consulting background, and you need number crunchers who are going to help you IPO when you get to growth stage. But we don't find those backgrounds as useful at the pre-seed stage. Third thing would be community connectivity and knowledge sharing. So Ollie, Gary and I were chatting about this before you guys joined the call, that that's obviously the whole idea between startup to stand up, is creating a community of founders where you guys have each other and can bounce ideas off each other. And that stuff is super, super useful. So we have a lot of founders in our portfolio now. I think it's 220 across 90 something companies, given the volume we've been doing in the last couple of years. And we've thought about recently how we're going to start segmenting that into smaller groups, because we know that DevOps technical founders are going to want to talk to each other, and they're necessarily not going to have too much overlap with a kind of a consumer platform founder with a load of marketing knowledge. And having those people all in the same place is great, but we want to start splitting that out and helping them make more meaningful connections in the portfolio. And then I think the last piece to mention is follow-on funding. So we've obviously got the ability to take a pre-seed company through our seed and A fund, which is definitely a good selling point for us. But I think more importantly, we have an in-house BD team, fundraising team. We've got 8 or 9 people in that team. And they've got 2 responsibilities. One is raising for the fund, obviously, that's what keeps Fuel going. But the other job they have is when our companies want to raise more money at any stage, and it's not something we're doing through the Fuel funds, we basically give them the blurb saying, this is everything you need to know about this company. They can go out, and we've got a network of about 1,000 VCs, 1,000 family offices, and about 3,000 high net worths across mainly the UK. So that we can accelerate fundraising. And again, it's about giving time back to founders who are trying to build something and trying to build something cool. So we've done a couple in the last few months where we've raised, I think 3 million for someone, 3 million of someone's 7 million Series A. They got a lead investor. We found the 3 million in about 24 hours. And another one where it's a seed deal, but at a high valuation. So I think it was a £10 million round. Much higher than the kind of thing we normally do, but we just got really excited about it. And they got a couple of VCs on, so us, we did 3, another VC did 2, and we found the 5 million for them in a week or so. So we've got that ability, which is really helpful, because it means that you guys don't have to come to the table with this massive investor network, which we always kind of say, why would you? You're trying to build a company, you know that area, you don't necessarily know all the VCs in the world. But yeah, so that's a bit about what we're looking for on founders side. Investors I won't dive into too deep. Principally, they're looking for a return. So we're targeting 5 to 10x on every fund over a 10-year period. The tax efficiency plays a big part for us in that all our funds are SEI, SEIS. And there's direct follow-on capability, like the fact that we have that angel network. A lot of those angels are our fund investors. So we offer them direct at Series A, Series B, which a lot of them like getting that direct access. And that's the reason they invest in the funds in the first place. And then we also give them a lot of opportunity to interact with the companies. We talk to the companies and say, tell us who you want to meet, tell us who you want introductions to, because actually our investor pool are ex-entrepreneurs, either of kind of more traditional businesses or startups in the tech world. So a lot of knowledge on that side of things. And obviously we're always trying to improve this. Like we're hiring in-house recruiters right now, because the biggest pain point for our teams is hiring and retention. So if we can bring that in-house and then not have to pay 25% in the market, we're obviously benefiting them, and we can do that on the balance sheet that we have. So that's the first point. Second question to dive into, to what are the qualities and skills you look for in a founder? I mentioned in the intro that that's 60-70% of our decision at pre-seed, but it probably helps me to give, I kind of think there's a almost more important question than this, which is how do we look at a business as a whole? Because that's going to be how you guys present yourselves moving forward. I think this is really useful to chat through. So when we look at a deck, there's 3 things we're looking for, and this is like very much tick box exercise. So a large, and I always say, and sensible analysis of the market. Like VC businesses are obviously going to be looking for something with that kind of 10, 100, 1000x potential. But the key reason for including sensible in there is we see so many market analyses that are not representative of the actual market that you're going after. Like the amount of people that are doing something, a vertical within HR tech, and they just put their TAM as the HR tech TAM because it's easy to get those numbers from Gartner or McKinsey. And it's completely irrelevant to what the founders are doing. So that's quite a frustration for us, is saying like we're in a $100 billion market when you're in a $10 billion market, which is big enough. You don't need to go down that we're this big route. So that's one thing to say. Also, when you present TAM, SAM, SOM, what we often see is the TAM is the whole of HR tech the SAM is 10% of that, and the SOM is 10% of that. So we're looking at 1% of the TAM, and there's no logic behind why 10% and 10%. It's just taking numbers. So that's something I would always say, like, look at those reasons why you're giving that SAM and that SOM, because that's really important. A second reason is, a reason why now is the ideal time. We've got to understand why you're building it right this second. And the third one is a realistic means by which the business can monetize. We see countless amazing ideas where there's no monetization model, and you just think, I love this, I would use this, but I wouldn't pay for it, and I don't think anyone else would. So key to get that monetization strategy in there somehow. So once we've cleared those hurdles, then talking very much about the team, it comes down to domain expertise. We want people to know about the market they're in, the players, how it all works. We want to see a track record of success. We always talk to people's existing networks and say, be that previous startups or employment at a corporate or another startup, what have these people achieved? What have they done? Required skill sets across the team. So if you're a solo founder, we're looking for someone who's got the GTM and the tech capability. If it's the team, we're looking for those things across the team rather than having 3 guys who are ex-sales guys or 3 guys who are ex-tech guys. Or girls, obviously. And so those kind of 5 areas of key importance would be go-to-market, operations, product, tech, and strategy. So those 5 things have to be within the founding team. And then it comes down to how you come across on the call. So the people that we talk to, be it the founder on their own or the founding team, like, we've got to see confidence. We've got to believe that you believe in your idea. We've got to see the knowledge. Does the go-to-market fit the business? Are you thinking about sales in the right way? Does the annual contract value justify the CAC? And B2C, does the payback period justify the CAC? We've got to see passion. We want you to, like, love the space you're in, love the idea you're building. And that really comes across with some founders. And then we've got to see an ability to execute, ultimately. There's really passionate founders who don't ultimately look like they have the ability to execute. And there's people who are executors who don't have the passion. So it's about getting the right balance there. So I think hopefully giving you that, how we look at something in total, and then honing in on the founder qualities gives you a bit more context there. A shorter question, are there any industry sectors that we're avoiding now? So at a total level, Fuel doesn't touch medtech and biotech and hardware. So we don't have experience within the team in the medtech biotech space, and in the hardware space, it's a completely different proposition. That, again, none of our investment team have ever built a hardware product. So we don't want to dive into that space because we don't have the knowledge, and we won't be the best partner for a startup in that space. In terms of trends right now, last mile delivery, unit economics are very, very tough. As I'm sure most people are aware, clothing rental and upcycling is a tough one because we just see so many of them. And again, at pre-seed, if you're seeing 10 plus of the same idea, you have to steer clear of that market because there's just too many variables, and you cannot pick a winner. Even if we do love that idea, we just don't know who's going to come out on top, so we can't dive in. ESG, climate, e-commerce focused plugins. Again, we are actually doing one of those at the moment, but we think we've met a really, really cool team who are already halfway between our definition of pre-seed and seed revenues. But again, we've seen a lot of those. So very, very tough to say this is the one that's going to come out on top. And we are taking that gamble in that space, but it's definitely higher risk for us in terms of profile than we'd think about elsewhere. And then AI video calling, again, just seen too many of them. So very, very tough space. And then also, one of the things to bear in mind is, I mentioned it earlier, but if something's too early, we'll generally say, you are too early for us, but we really like what you're doing. So if you don't raise now, come back to us because we're super interested. Seeing the question from Marcus, is inflation having any effect on the industries you focus on? I was going to talk about this in a bit because there's a question around bull to bear market, and I can incorporate inflation in that. But it massively differs across stage, I think, is the key thing to talk about. So it's obviously had a massive effect on discounted cash flow models in the public equity world. And so those valuations are depressed. NASDAQ's down 30% plus since November. That has an immediate knock on at pre-IPO growth stage startups, because like Klarna were raising at 46 billion, now raising supposedly at 6. I'm not sure if that number's public yet. Because they know that at an IPO, they can't get a 50, 100, 200x multiple. I think Snowflake IPO'd at 80x revenue and went to 250x revenue within 3 months a couple of years ago. We're not going to see that for another 2 years. So that has a huge effect at growth stage, which has an effect at Series A, that they're just doing fewer deals. Their LPs are coming to them and saying, I know we invested in a 3-year fund, but can you push this out to 4 years? We need you to stretch that cash because we're not going to have the cash to reinvest in 2 years' time. We need it to be 3 years' time. So that gets knocked on, but the effect gets lesser and lesser as you go down the chain. So us at pre-seed, we haven't changed anything about what we do. We were always quite valuation sensitive. We were always doing high volume, and we were always looking for the same thing, and that hasn't changed. And we hope that the best of our pre-seed companies will be in that crop that are getting Series A funding, even though they're doing 25% fewer deals. And then again, the ones that get that growth funding, even though they're doing, well, by the time they hit that, we're hoping the market's obviously corrected. Corrected is probably the wrong word. Gone back up a little bit. So there's a lot of things that play there. Inflation definitely has an effect, but there's also not just inflation. This market is like, it's been affected by 3 things at the same time. There's the inflationary environment. There's the Russia-Ukraine conflict, which just takes confidence away from the market. And confidence is probably the most important factor in vanilla public markets. And then there's supply chain constraints all over the place. You've got semiconductor constraints, which look like they're alleviating now. You've got gas constraints because of the conflict. You've got several other specific markets. All those things are slowing things down in the public markets, which have that same knock-on effect. So I think the key factors for us, just looking at, again, at a super early stages, we're maintaining the quality of investments that we've always looked at. We're still looking at everything in the same way. That's high volume by nature. So we've got to ensure that founders are really hyper-focused on revenue. And we tend to be like that anyway, because we're saying to them, you take this pre-seed money, you're basically firing a starting gun in terms of the fact that you've taken institutional money, and therefore you have to be generating revenues at the end of this round, unless you're building something deep tech where we know that you can raise based on what you built, which is 2-3% of cases, if I'm honest. So being super focused on revenue and having break even as an option. That if you don't get that fundraise in 18 months time, can you pare back the team to the revenue you're on, so that you can just sit at break even for as long as it takes to get to the revenues where you're able to raise that seed or that Series A round. So that's super important. And also for us, we're not really investing in runways under 18 months at the moment. So there's a lot of founders that come to us and say, ideally I'd raise $1 million, but I could do this for 250K and then come back to the table in 3-4 months time. They're the kind of deals we're not doing, because there's very little chance that actually works in this market, unless you really go from 0 to a decent level of revenue in that 3-4 month period. I think the key stat there is that 90% of the companies that we invest in across any level undershoot their conservative revenue estimate. And that is indicative of everyone across the market. Everyone has, here's my kind of standard, ambitious and conservative revenue lines. And it just takes longer than people think it's going to get these things off the ground. So that's super, super key to bear in mind. But at the same time, I think this is I wouldn't say take that advice as write an even lower conservative estimate, because it's a weird game. Because if you're looking to take something to a VC, they want to see a massive opportunity. So if you show them an opportunity that doesn't generate enough revs over 3 to 5 years, they won't think it's a VC business. So it's a massive paradox, and that's probably why 90% undershoot the mark. So it's key to get that balance of, I'm going to show you something big enough, but this line is at least achievable if I do everything right, which is funny. Just saw another question pop in. Mark's asking, hi Tom, there's a belief that VCs require 100 approaches all the time. How do we get noticed ahead of the others when we arrive in your inbox? So I think very VC dependent. For us, we look at absolutely everything that comes in, because you have to at pre-seed, because there's loads and loads of pre-seed founders who just don't have a network. So judging someone by the quality of how they come into your inbox, I think is really, really unfair at pre-seed. At Series A and Series B, I kind of get that. Like I run a series of dinners for B2B SaaS investors, which we had on Wednesday, and I was talking to people at Ox, SoftBank, other bigger players, and they say that who the deal comes from makes a massive difference as to how they look at it, because they know who gives them the really good deal flow, and they know that the stuff that isn't coming in through those channels, they don't have a relationship with, or they can't get into the door through those relationships. So for us, it doesn't really matter, but it does depend on the stage. So for us, just sending in the deck as per kind of how we look at it would get you noticed. Obviously, as long as we like the idea. The thing is, we've got a team of 3 of us who are looking at deals, like deal leads. We see about 100, 110 a week. So the kind of brutal reality of it is we probably take, of those 100, we probably take 10 to a first call. Some of them it's because they don't have the SEIS eligibility, so it's quite easy. So if you've got the SEIS for our pre-seed fund, that's putting you in that top 50% probably. And then the top 20% of those are the ones that we're talking to. And this is averaging out over weeks. Sometimes we talk to loads and sometimes we talk to 1 or 2, just because of whether the stuff that's come in that week is right for us or not. So I'd say very dependent on stage in answer to that question. Plans for a fuel accelerator, partnerships with, hey Gareth, how are you? We have talked about this a lot, and it's not something that we're going to do because it requires a huge amount of additional resource, and we're a small fund ultimately. Like we get called a leading fund in the UK because we do a lot of high volume, but ultimately because we're an early stage fund, I say we're only investing about 60 million a year. So we don't get management fees that allow us to hire massive platform teams, have in-house legal, have all the stuff that the bigger Series A funds have, which is very, very helpful. So we just don't have the budget to go into that accelerator phase of here's a founder that we love, here's an idea that we love, they've got the right skill set, let's put them together. We think about doing that all the time, but we just don't have the capacity to. So partnering with is definitely more on the agenda. It just depends what that relationship looks like. So I've talked to quite a few accelerators in the past who are looking for us to make a commitment upfront to fund businesses that they want to take through an accelerator, which we obviously just can't do. Again, we can't take that risk on. We like these, let's say 5 or 6 ideas, and we are 100% going to invest in them in 6 months' time, because we just don't know what the product's going to look like, what the founder is going to have learned over that 6-month period. So we always say to them, as we want to look at everything, send us everything, unless it's medtech, biotech, hardware, and we will take a look at it. I'd say if you are working with accelerators, the one thing that is very difficult that they do that you should encourage them not to do is send you their entire cohort in one email. When they send 20 in one, you just get lost in it. And you, like, as an investor, you don't pay, you can't pay as much attention to that. So if you can persuade them to send you as a one email, that will pay off tenfold in terms of the amount of conversations you get, I would imagine. Another question came in, I think on, if not 18 months runway, what's the ballpark figure in terms of runway you're looking for with regard to pre-seed and seed? I think for us, it's always going to be, at the moment in this market, 15 at the very, very least, and somewhere between 18 to 24 based on what you do. I think one of the pieces of advice I give every single founder I work with, whether they need it or not, I tell them every single time we speak, is that you should keep your burn super, super low until you're finding product market fit, because that is the number 2 way that a startup dies after the founding team falling out, statistically, is running out of money. And that happens because you have so much belief in your idea, which is great, and we invest because of that passion and charisma. But then you think, like, this is just 100% going to work. There's no way I can see this not working. So you get the money from the investors and you pile straight into hiring a kind of a seed-sized team in preparation for a seed raise. And then it takes you 6 to 9 months longer to get that first revenue than you thought it would. And you've burnt through all that capital. So work out what the leanest way is to get to finding product market fit, and then pour money on that fire. So for most 2-3 person founding teams, that's hiring 1 or 2 people that are just filling in a gap that you don't have, that you really, really need in order to get there. Not going out there and hiring 5 to 10 people, because that's the amount of capital you've got, so you can actually afford to do that. I've just seen another question pop in, I think, before I close that. Just thanks for candid honesty. What do you feel like to see in pre-seed marketplaces? Any particular criteria and current trends? So marketplaces is really much easier from a tech perspective, much harder from a go-to-market perspective. So marketplaces, we don't mind if the tech is outsourced, whereas we do tend to give that a harsher lens with a consumer platform or a SaaS tool, because we know that the tech is the simpler part of a marketplace. You ultimately can use a lot of the existing back-end tools to build on. And a lot of people use a dev agency and then look to bring that in-house at seed and A. So we don't mind that at all. What we really want to see is you've obviously got the chicken and egg problem. So you've got supply side versus demand side on a marketplace. So that's probably the principal reason why we have marketplace ideas that we love that we don't end up investing in, is they haven't got that piece right. And I have experience of that myself in the SaaS business that we built to 15 million ARR. We started to jump into a marketplace idea, trying to build the app store on the SaaS business that we were building. And I also very nearly went to Hopin to be head of partnerships to do exactly that, build their app store out. So again, the other harsh thing about a VC is the more knowledge you have in a particular area, the harsher lens you apply to that area, just because you can go deeper and deeper and deeper into it. So that's not something that you should consider, obviously, because it's not relevant to whether to kind of how things are going to progress for you. It's just another reality of it. Another one's just jumped in. Can you run through again the 5 times roles and startups that you want to see covered? Yeah, absolutely. So I'd say in order of priority, sales, tech, and product are essential. And then strategy and operations are probably ever so slightly secondary to that, in that by the time you get to seed, that'll be a necessity. But at pre-seed, we can kind of, I'd say, not be so stringent on that, because pre-seed investing is accepting risks. So I talk to Series A investors who do 2 or 3 deals a year, and they will only do the deals that they think there's absolutely no way it can go wrong. And they don't see a risk. They've covered every single corner of it and they don't see a risk. If we do a deal at pre-seed that has no risk, we've been lied to, because it doesn't exist. So it's just about accepting which risks you're happy to take and which risks you're not. And having kind of operational excellence at pre-seed is not one of those things that's a necessity. So we like to see that someone's going to be handling that, or they're going to hire that expertise, but we don't need to see it. And again, strategy, that becomes more important the more complex the business gets. Like, we want to know that you have a vision and that you're looking to get somewhere in 5 to 10 years time, but we don't need to know every step along the way. And one of the things that I would actively say to people is, don't write a business plan as a pre-seed founder, because you will end up spending 90% of your time on that business plan, because it will change every week. So have high level goals, bullet points, OKRs, KPIs, that you're looking to tick off, don't go down the road of writing a 10, 20-page business plan. I'm just going to check with any other.
Tom, on that, so if you are in between pre-seed and seed, so using myself as an example, we're just getting to the 25k ARR, MRR, is for us to, and our plans are to go to a seed round in the next few months. Do we need a business plan for that? Because we didn't have a business plan when we went for pre-seed angel money.
I would say still no. Like the way I can share this some information with you guys afterwards. For pre-seed, this isn't necessary, but we think there's a very specific way to raise every round, regardless of stage, from seed all the way through to IPO. And we actually have a Notion page that we built as the pre-seed team that we share with our founders that says, when you go to seed or Series A, this is how you should do it, which is actually part of the next question. So there's a question on which sectors are we favouring, and we look at this as a firm and an individual level. I won't dive into this because it's, I think the next question is a lot more interesting. So personally for me, my background is all B2B and B2B2C, and I look at more specifically SaaS and B2B marketplaces. I don't tend to dive into the B2C stuff because there's guys in my team who are so much better on that side than me. So if I see those ideas, I literally ship the deck over to them and say, what do you think? And obviously they're seeing 2 or 3 times the deal flow in that space that I am. So there's a lot of ideas I look at the deck and go, that's quite cool. I'll send it to Alex. And he says, I've seen 10 of these. So yeah, on the individuals, for me, I love at the moment DevOps, workplace productivity tools, AI ML tools, B2B e-commerce, and mobility and logistics, the things that I tend to specialize in at Fuel, and that really bore a couple other people in the team, which I find really interesting. So that works for me. But yeah, onto that kind of question of how should you, what pitch decks or approaches catch your eye and grab your attention, which is kind of tangential to a question that someone asked earlier of how do we get noticed. And I will share that, how we think a round should be put together with Ollie and Gary afterwards, so that they can send that stuff onto you. I don't know how I'm going to take it out of Notion and put it into a different format, but hopefully can think of something. So I think this is probably the best question on here, because I think in my opinion, there's a really specific way that a VC wants to see an idea laid out. And this does depend on stage, but for pre-seed and seed, I think founders often get into the mindset of like, I'm in a really, really tough spot in terms of like trying to get this idea that I love off the ground. And I'm doing the hardest thing in the world, and you are. But you also have to have an appreciation of a VC's time, because when we're all looking, everyone in my team looks at every single deck 100 a week. So we have to make a judgment call in the space of 2 or 3 minutes on each deck, because that's already hours of our week. So I talked you through the pieces on market, why now, and monetization. So I will open a deck and I'll go straight to those 3 slides and say, right, tick box, tick box, tick box. But beyond that, I think before I dive into structure, it's super important to understand the purpose of the deck. It's just to give a taster and to get you in the room with the VC. It is not to sell the entire idea like an essay business plan, because if you're slide after slide after slide of thick text, that's not a 2 to 3 minute job for a VC. And you probably won't get what you want to get across, because the key messages are lost in the blocks of text that a VC doesn't have time to go through. So I would say the founder is the ultimate pitch clincher, not the deck. The deck is just trying to get you in the room. And therefore, structure is really, really key. So this is the way that I think it makes most sense to build a deck. So firstly, set the scene. What's the one-liner? Can you explain your idea in one line? And that line is going to get me excited. then go into the problem you're solving, and then go into the solution. And if you can embed a video or a demo that brings it to life, that's really, really useful. But I say start with that stuff rather than, like a lot of people say, start with traction or start with market size because it will really excite investors. Although I flick to that stuff in the deck first because I just want to check it, I then want to read it in a logical story. And if you're telling me about the market before I know what the idea is, it's really hard to contextualize and decide, do I actually believe in this market that they're offering, because I don't know what the business is. So start with setting the scene, then go for the big selling points, which for any business are going to be the traction, the market size and revenue potential, and the why now question. What's the gap in the market? And included in that is the competition and USPs piece. So whatever order is best sells your company, that's the order you should do those slides in. And I also say market size and revenue potential rather than just talk about the market, because a market can be billions and billions and billions. If you're on a marketplace model, GMV model, where you're only taking 0.5% of revenue, then actually $100 billion market is not huge. But it tends to be the payments world where you're getting 0.5% on transaction fees, and they're $1 trillion markets. So the revenue potential is really important with that. So after you've gone into those selling points, then clear all the detail up, which is talking about the go-to-market strategy and the scalability of the idea within that, the business model. I always say talk openly about the risks, because it proves you know your market and your product. And a VC is going to ask those questions anyway. So if you're heading those questions off with just like, we know these are the risks, and you don't need to go into them in detail. Again, you're trying to give a few bullet points to give someone an idea. Then I have confidence that you've thought about those things, and I'll ask you when we talk, but I'll know that you've already thought about them. So I don't be scared of the risks, because every pre-seed and seed company has risks. And then I think the last bit is the clincher. So who's the team? Introduce yourselves and your experience, tell your story, talk about what your vision is. Again, that might be 1 or 2 bullets saying this is where we ultimately want to go with this. That can be included in that one-liner thing at the start. That's just preference. And then talk about what your ask is. So how much are you raising? What are you going to use the funds on? Is it SEIS and EIS? You can include all that information in it's a lot of information, but it's very easy to see, to put that in a very easy to understand and easy to read format. I will carry on, but I'm just going to answer Gareth's question quickly, which is, are you seeing many DEX approaches sent as trumpet pods yet? I don't actually know what that means, Gareth. So in a sec, do you mind elaborating? Go on, Gareth.
Oh, sorry, I thought you only gave me a sec. Yeah, it's the thing that Nick Telford, Telson, and Rory have put together. The ex-Design My Night guy, they put together this new way of pitching, and they're aiming it at startups trying to pitch to VCs. It's like a microsite basically with embedded video and burst.
I didn't know if that's what you were talking about, but I haven't seen a Trumpet deck yet. We're actually investing in a competitor to Trumpet, who are focusing more on B2B SaaS sales than they are on pitching to VCs, but the idea is very, very similar.
Can you disclose who they are?
I can't yet, because we haven't even signed the term sheet.
No worries.
It's in negotiations, but I do really like that idea. And I know it's got a lot of verticals, because these guys will ultimately probably switch into each other's verticals at a point in time. Exactly. But there are a lot of, so most people send a PDF, which is fine. The point, actually, I'll just finish what I was going to say. So that was all about structure. The next thing is length. This should all fit into 12 to 13 slides. Everything that I just said should be a slide and no more. And if you can't get all the information that you want into that slide, it's because you're trying to say too much. So go through the things that you want to say and say, okay, these are more important than these things, and therefore I'm going to focus on these 2 or 3 things. The third piece, is design is key, which comes into the Trumpet question. If your deck looks shoddy, investors will assume you don't care. First impressions do make a difference. There are so many great freelance designers out there, so use them if you don't have that skill set yourself. So then talking back onto Trumpet and those kind of tools, PDF of a PowerPoint is going to look shit if you're doing it yourself and you've not got a designer come in and do it for you, just because it doesn't grab attention. There are so many great tools that you can use yourself, like we're in Glorify. Canva's obviously a massive one. Freelance designers do not charge that much to take your idea and turn it into something really, really cool. Otherwise, you've got DocSend is a useful tool in terms of taking a well-designed PDF and turning it into a link. It becomes way more shareable than a PDF, because I can then just ping it on WhatsApp to groups of VCs who I think might be interested. And VCs have a lot of WhatsApp groups. Like I'm probably in 10 different WhatsApp groups with B2B SaaS specific. I'm just about holding on to young VCs. There's ones that are like, I'm in one called South of the River Crew, just because I used to live in Brixton. So there's groups all over the place. And then pitch is really, really good, because you can embed a video on every slide, so you can effectively pitch in the presentation. But bear in mind again that the written deck is just to give you a taster, and the pitch itself is to sell it. So I want to be able to look through a pitch deck without watching the videos and still understand, but having those explainer videos on there is really, really cool as well. So design, the third point, and then fourth point is how you get the points across. So again, minimal clutter on slides. What is the key message? How do I ensure that that piece is read? Save all the detail for when you pitch in person, because that's when you're really going to sell someone. Like we see a lot of great ideas where we just think the founder's not there. And so it is ultimately going to come down to you guys. And then don't use jargon. We find so many people who used to be in IB or hedge funds, typically they're the worst, who just go down the jargon route. And I'm the only one in my team who understands it, because I'm the only one who comes from that world. So you lose the interest of the other three people in my team very quickly, which makes it harder to sell, because we have a structure where we've got principal, senior associate, associate, and analyst. But associate and upwards, we generally have an equal vote when we're talking about companies. We want it to be super democratic. So if an associate in my team really, really hates an idea and has a really good reason why we shouldn't do the deal, we won't do it, even if everyone more senior really loves it. And then I don't know how we are for time, Ollie. There's one more question on the list that we chatted about originally.
Tom, please feel free to cover it.
Cool. And it's another really, really interesting one. Can investors do more for founders of their investee companies? So the easy and obvious response is yes. Everyone can always do more. But the big but is, I think this again depends massively on the investor, both from like the mindset and the culture they have approach, and the amount of money they have to spend on helping their founders. And also, are you asking this question from a company, Fuel perspective, or an investor, Tom Hibbard perspective? Because I think that makes a big difference as well. So the first point from a personal perspective is the key for me, like whether I think I have done well as an investor, is when a founder runs into trouble, they only think about me. They literally pick up the phone and call me and say, we've got this problem. Because I know that there's trust there, because they're not scared that I'm going to take some sort of negative action as the VC, as the investor. And almost more importantly, they think I've got a skill set that can help them get out of this problem, or give them some advice to get out of this problem. So that I think is the first piece. The second piece is to really be humble and understand that no one knows everything. So I know B2B sales, strategy, product market fit, and fundraising really, really well. Anything outside of that within the startup world, I either know quite well, or average, or not well at all. So what I do know is who can help with those things. So again, a founder will call me up about a in-depth product problem, because they know that I can put them in touch with someone who can help, even if that person isn't me. So I think personally, I do everything I can for the founders I work really closely with. And that is tough at pre-seed because I'm looking after quite a few at the same time, compared to a Series A principal who might be looking at 2 or 3 at any one time. I'm probably looking at between 10 and 20 at any one time. And then I'm talking about it on a firm level. We talk about this as a strategy meeting once a month. And the question we get asked most is, how can you help us? Every single founder is going to ask that question. And I talked about the proposition for investors at the start. And I kind of said at the end, we're always looking at new ways to help founders. So at the moment, we're looking at 2-3 roles. So we're starting to build out that platform team, because we're starting to just about hit the scale where we have enough management fees to build out a platform team. So we're looking at building an in-house recruitment team. So we polled all of our founders and said, who uses recruiters and how much do you pay for them? And the answers came back that before people have in-house talent, they're using that for 75% of the roles they hire. 25% are coming from network, and the average they're paying, when we averaged it out, is about 22% commission on those. So we looked at I built a business model out that said, if we hire a talent lead and a talent partner, a 2-person team, if we did this many hires a year across this many roles, we would need to charge 7.5% to break even on that. So I looked at the CVs last night, actually, because we're hiring an analyst in my team. We're hiring those 2 recruitment roles. Hiring 3 people at the same time as doing the job is always good fun. And so we're bringing those people in to have a much, much cheaper way for our founders to hire the talent they're looking for. And one's going to be focused on sales, one's going to be focused on tech, because they're the 2 areas that people have the most problems in as well. And then we're also looking at a community lead. And this is probably going to be fulfilled by that analyst role in the early days, but we're ultimately going to split that out into its own role so that someone can be purely focusing on helping connect all the founders together, and make sure that there's playbooks, advice, and everything else that we just don't quite get the time to do. Just looking at the stuff that's come in, our project beam card would be unable to meet your criteria. Do you have contact with a VC to operate in our technology who we could approach? Yeah, absolutely. I know a lot of different people across the board. Pre-seed is the toughest space. There's probably 10 or so who I work really closely with who are very interested in everything that Fuel does. And so I can kind of send everything to those people. So that's worth noting. So if I kind of really love someone's idea, but we can't do it, I'll send it to a couple of people who I think are closest to that idea. Last question is, how much more difficult is it if you're a solo founder for Fuel to be interested? Really, really good question, because we don't like to judge a solo founder. We know that it's going to be slightly harder, but we also know that a lot of the solo founders we talk to are putting a 30-40% options pool aside because they plan to hire founding people into the team after they've raised the money, because it's a much easier from a negotiation perspective when you've already got the money. It's less risk for those people coming in. So if that's the plan, we generally say that's fine with us, as long as you're getting the right people. We're happy to help you with that in terms of just like chatting to them and seeing if we think they're the right people. If you're not planning on doing that, and then you have to have all those other things we talked about. You have to be on top of tech strategy. If you're outsourcing it, you need to know exactly how it's working, what's going on. You need to know the go-to-market inside out. That's kind of the reason why these companies don't work out, is pretty much always go-to-market. Everyone builds a good product and then people can't get it to market. And then the product. We talk more and more about at the moment about how we're judging every B2B proposition with a B2C lens in terms of UX and UI, because everyone now expects a great UX and UI in everything they use, every tool. So we won't judge it with as harsh a lens. We'll basically, like, we won't ask the question. We'll just wait for them to say, I know that the UI and the UX isn't quite there right now, but it's going to be a core focus of us in this round. And one of our first hires is going to be a designer for this reason. Like we wrote a term sheet last night for a company that their UX is okay, but they're dev first, they're a dev tool, they're very B2B. And the developer side of it is insanely good. So I trust that he'll sort the UI UX side at some point in time. I've seen more comments come in.
A lot of love coming in, Tom. People
It's
have
nice
really
to see.
enjoyed this. I think it's been very insightful. Whilst we got Tom on the call, is there any more questions from anyone, please?
Do we have Tom's contact details if we want to pass on a project?
Absolutely.
My question.
If you send them through to me,
Tom at fuel.ventures, but I'm sure Ollie and Gary will send it around.
yeah. So if you send them through to me, Peter, along with any decks and supporting information, I'll forward them over to Tom for you.
That's great. Thank you very much. Excellent presentation, by the way. Thank you.
Cool. Thank you. I'm glad people enjoyed it. I try and be candid rather than talk shop and stay within party lines.
Tom, just a quick one. I had loads of questions, but obviously we're running out of time. I think one is, it would be great if we could have Tom 2, and another version. What I would love to look into as well is what VCs are. So what I'm saying is, we're all talking about startups. You're actually a startup yourself, really, and you're a company, and you're building. You go through the same problems as we do, but we don't look at that. So it'd be really good to get an insight, maybe in the future, of what you go through, how you do it. The other one I want to go into is, do you look back and go, oh my God, we missed that? So your criteria, technically, you wouldn't have invested in Uber, or you wouldn't have invested in Airbnb. One is, so these are questions for next time probably, is, would you, do you regret that? Have you had companies come to you where you go, oh crap, we missed out on them because we're going through so many presentations, etc. I'd love to have a really good talk on that.
Yeah, so I don't know if you meant follow up by getting someone like Alex and my team on, because he's way more consumer focused and you get a slightly different perspective. I'm hoping the messages on fuel would be relatively similar, otherwise we're doing something wrong. But very quickly in answer to your two questions, and I'm happy to expand on it another time on these. In terms of look back, if we don't talk to a company, if it's not one of those 10 of the top 100, we're very unlikely realistically to remember that we even saw it. So there's that element of it. We're not that old as a pre-seed fund. So I've not got to that point where something I passed on is now raising like 5-10 million at a ridiculous valuation. Maybe not, sorry, ridiculous in terms of like great, maybe not ridiculous in terms of the success they're having. So I haven't got to that point yet. I am pretty rational as a person, don't get too emotionally involved in things, which I think helps a lot. So I'd probably be able to kind of mentally separate it and say there was a very good reason why we said no at the time. The only ones that I'll probably be a bit more upset about is if I loved it and the team didn't. But I know that's going to happen the other way around. I've said no to things that they really, really loved. So they're definitely going to be WhatsApping me at some point being like, look what you've done. And then the kind of what is VC and the problem side of things on that. I don't remember if we talked about this, Ollie and Gary, last time. It's very, very, very relevant to us because we actually use that as, I say use, it's a reality. We talk about that as part of our sales pitch to founders and say, like, we are still only 5 or 6 years old as a fund, and we treat ourselves like a startup. We are still trying to find product market fit. We're still trying to build out our product, which is our proposition. We are still making mishires. Like, I had to let someone go on Friday, really, really sad, really nice guy, but just didn't fit. And now that's why we're hiring someone on the analyst side. So it's all the same pain points until you hit the Sequoia, Axel, A16Z index, Bulletin type brand and size. They're the only ones who really don't have the excuse of saying we're a startup, because they've got, like, I talked a lot about management fees in this because it's really important. Like, we have the management fees to build a fundraising team and now a recruitment team, and that's great that we can offer that. A16Z raised 2 $5 billion funds this year. So they've raised 10 billion in fresh capital on 2% annual management fees. So they've got $200 million a year coming in from just those 2 new funds, let alone the other 7 or 8 they've got. So they probably got a budget of around $350-400 million a year to spend on things. And we probably have 1%, less than 1% of that. And we're still paying custodian fees, fund manager fees, compliance, legal fees, everything comes out of that. Salaries come out of that. So it's such a different proposition. There's a reason that those partners pay themselves 1.5 million base plus bonus plus carry.
Thanks a lot, Tom.
Excellent, Tom. Thank you very much. Any more questions for Tom? Anything at all? Anything in the chat?
Not from me, but that was very insightful. Thank you.
And Tom, thank you very much for offering to send us that package that we can share with our members. That I think is going to be very, very useful to everyone. I think that would be brilliant.
Yeah. I need to work out how to, because I think the Notion page we've got, we want to keep it to just founders. So I might just replicate it and then share it with you guys to share on.
That'd be awesome. And then we can share it with our community.
Yeah.
We're going to give you a lot of love today on LinkedIn and big ups, because I think you've deserved it this morning. It's been awesome. Wouldn't you agree,
Cool.
Gary?
Yeah. I think someone said in the chat it's one of the best talks we've had on Startup Stand Up. So it was very candid and honest.